Up next are structural reforms, and the concept behind the structural reform is very simple. You either want to change the structure of a bank beforehand so that it never becomes truly too big to fail, or if they already are too big to fail, you want to make sure that if they do fail, they fail in a gentle manner. These are known as the ex ante, before, or the ex post approaches. Let's cover both of these. Among the multiple types of regulation that was passed to prevent the effects of too big to fail banks after the great financial crisis, one specific type are structural reforms, which, as the name says, are reforms to the structure of banks, and they consist in specific of measures to number one, either prevent banks from becoming too big to fail, or on the other hand, to protect the financial ecosystem if a bank that already is too big to fail does fail, making sure that they land gently instead of crashing. The two main types of measures represent this, a before approach and an after approach. The before approach is known in Latin as ex ante, which means regulating banks as going concerns while they're still alive. The goal is to regulate a bank and break it up before it goes bankrupt or becomes insolvent. These measures usually consist of breaking up a large bank, for example, limiting the types of business they can get into so that they don't become too big to fail anymore when they go under, if they go under. And then we have the after approach, ex post measures in Latin, and these regulate banks as gone concerns. That is, when bankruptcy or insolvency occurs, when they're gone, as the term says. And these are usually focused on the proper winding down of an insolvent bank so that it causes minimal shock to the system. Again, so that it lands gently instead of just driving off a cliff. Let's start with the ex ante approaches. These regulations aim to prevent gigantic banking institutions with multiple complex activities, and they usually involve separating these activities in some way. So banks are broken up by division or by types of activity. The two most relevant implementations of this type of regulation are the Volcker Rule and the Vickers Report. So the Volcker Rule in the US was part of Dodd-Frank regulation, and put simply, it prevents banks from proprietary trading, or owning a fund, or sponsoring one which does it, such as a hedge fund or private equity fund. It has the same rationale as the Glass-Steagall Act back in 1933, which is to separate the retail lending activity of a bank and the riskier investment banking activity of that bank, to isolate both sides. Then, in the UK, we have the Vickers Report, or specifically, to be more accurate, the ring-fencing guidelines of this report. And these were implemented as any bank with over £25 billion in deposits needing to separate their investment activities into different companies. Germany and France, for example, and other countries have adopted a hybrid structure where they adopt the ring-fencing structure of the UK, separating the companies, but they also have a very clear definition of activities as in the US. So, although they sound similar, I really want to stress the fundamental difference between these two approaches, which is one of ownership separation versus functional separation. So in the Volcker Rule, there's ownership separation. In short, a bank and a hedge fund cannot be owned by the same entity. If you own a bank, you can't own a hedge fund, period, or vice versa. In the Vickers Report, the separation is functional. In other words, you can own a bank and you can own a hedge fund. You just can't have both in the same company. So both do achieve the similar goal in the long term, but their implementation is very different. Then we have ex post approaches. This type of regulation mandates the orderly winding down of a bank or a full bank holding company that is insolvent. In other words, we've already determined that the bank is going under, period. Now we just want to make sure that it goes under in a better way. And there are usually two major types of this regulation, the SPOE and the living wills, or resolution plans. The SPOE, or single point of entry, is a type of strategy to allow for an orderly liquidation authority or OLA process. So these are a lot of acronyms, but they are simple in essence. The SPOE, or single point of entry, allows the orderly winding down and liquidation of a failing bank at the parent holding company level. And this winding down is supported by both the regulatory capital and a cushion of what is called the total loss absorbing capital. The reason why this is called the single point of entry is because the only point of entry for the failing bank is the parent company. So the cushion with the capital to absorb the losses while the bank is failing is not in the bank, it's in the parent. So a new holding company is created, the bank is transferred to it without the toxic assets, and then the government or the regulator takes control of the new holding company. So it's about the holding company having a cushion of loss absorbing capital while the bank is going bankrupt that absorbs the losses until the bank is taken over by the regulator. The OLA process, or orderly liquidation authority process, is just the actual process for a bank that has this type of loss absorbing cushion to be placed in regulator receivership, in the case of the United States, the FDIC. So it's just the name of the process. So the parent has a cushion of loss absorbing capital. A new holding company is created, the regulator takes control of that holding company without the toxic assets, and the bank gets back up on its feet and is later sold. The single point of entry is the name of this type of strategy. The orderly liquidation authority is just the authority which performs the process. And the second category of this type of regulation are what are called the living wills. This consists of the bank performing capital and liquidity planning to decide how it's going to die in an orderly manner. It's almost a perverse exercise because the bank is literally putting on paper something like, hey, when we go bankrupt, or if we go bankrupt, this is how we're going to do it to make sure that the bigger system is not effective. What are some examples? The first is both the Volcker Rule and the Vickers implementation as kind of reincarnations of the original Glass-Steagall Act. In 1933, this act separated retail and investment banking. The goal was so that banks would not finance risky capital markets activity with retailer deposits, so the traditional banking business and the trading business would have a firewall between them. It was eroded in the meantime and rolled back mostly. These new regulations are kind of variations of this principle, re-implementing it in a way, being spiritual successors, if you will. Then, the goal of both ex ante and ex post approaches is to decrease systemic risk. This is because any bank that is too big and that fails will just shock the system. So the goal is to either prevent a gigantic bank from failing, or if it does fail, to make sure that they do it in an orderly manner. Then, the Volcker Rule was extremely controversial when it came out, because a lot of critics argued that the Great Financial Crisis was actually facilitated by the core banking activity, which was lending, and not investment activity. Banks went under due to bad credit and bad loans, nothing to do with capital markets activity. So the jury is still out on whether it actually reduces banking risk, but proponents of the Volcker Rule argue that it may not have prevented lending with lower standards, but it does remove other kinds of risks which also cause losses, such as selling securitized products in the capital markets. What are our key takeaways this time? The first is that there are two types of regulation to deal with the sudden implosion of a big bank and the effect that it has on the markets. Ex ante approaches, which act before a bank becomes too big, and ex post approaches, which act after the failure. Ex ante approaches consist of breaking up big banking companies in some way. Usually, it's through the separation of retail and investment banking activities in some way, either through an ownership separation or a functional one. Ex post approaches mandate the orderly winding down of a failing bank. So the bank is already going to fail. That's established. Now it's just about making sure that it occurs in a safe manner. And usually, this comes down to proper planning such as the waiving wills, also known as resolution plans, and also properly preparing the parent's capital structure with total loss-absorbing capital to trigger an orderly liquidation authority procedure so that losses can be absorbed while the bank goes bankrupt and enters conservatorship by the regulator. So as you see, there are two main types of structural reforms. Ex-ante regulation aims to prevent the bank from becoming too big to fail in the first place, and it's about, usually, limiting the activities that the bank can partake in, usually investment activities. Ex-post approaches are about what happens if a bank is already too big to fail, and it's also failing, by the way, and it's about modifying the structure of the bank so that it fails gently and not in a rushed manner.